What are liabilities? Well, we just dealt with assets and we said they're an element of accounting, and liabilities are just another element of accounting, but they're kind of the opposite of an asset. Whereas an asset was something that we owned, this is a liability are the things the business owes to other entities, and they have three components. First one is it's a present obligation of the entity. Second, it arises as a result of a past event or transaction. And third, it will result in an outflow transfer of future economic benefits or resources. So very similar to an asset. Asset was a resource controlled, not a present obligation, but pretty similar. The next one's identical. Assets arise as a result of past events, so do liabilities. And this one here, really all we did is transferred a couple of words. Instead of saying with an asset, we said it will result in an inflow of economic benefits to the entity. We just swapped it to, it will result in an outflow of future economic benefits from the entity. Let's have a look at these criteria one by one. So the first one is it's got to be a present obligation. What does that mean? It means the business has a debt and it has to settle or pay that debt. That's an obligation. And there's many reasons why that could happen, but some of the more common ones we'll deal with, it's because the business bought something but hasn't yet paid for it. Maybe it's because the business used or consumed something but hasn't paid for it. Maybe the business borrowed money and has to repay it. Or maybe the employees of the business have performed some work but haven't yet been paid for it. That happens all the time. Most employees get paid after they've done the work. Let's have a look at an example. Let's say Box Hill Furniture bought $20,000 of inventory to sell in its store from another business called Furniture Wholesalers. The account is due in 30 days. That means Box Hill Furniture has 30 days to pay it. So we've got our business, we've got our supplier called Furniture Wholesalers. They gave us $20,000 of inventory and we said to them, I promise to pay in 30 days. That is an obligation, a present obligation. What about this one? Box Hill Furniture took out a loan with NAB Bank for $100,000 with monthly repayments of $4,000. So here's our business, Box Hill Furniture. We went to the bank, we filled out all the forms and the paperwork, and the bank gave us $100,000. We now promise to repay $4,000 of that every month. That is a present obligation. What about the past event bit? What does that look like? Well, that means the liability comes about because the business engaged in a transaction with another entity in the past. Let's just take our same example and say Box Hill Furniture bought $20,000 of inventory from Furniture Wholesalers. That is due in 30 days. We said that's an obligation. What is the past event though? What does that mean? Well, that is the actual transference of the inventory. So I guess what that is where as soon as Furniture Wholesalers provides this inventory to Box Hill Furniture, that is a past event. That's a transaction. That's all the past event is. What about this one? On 1st of March, Box Hill Furniture received its phone and internet bill for February from Telstra to be repaid by the 11th of March. So we got Box Hill Furniture, Telstra. They send us a bill. It's February's bill. It's not due till March. That's how most phone bills work. We've got until the 11th of March. So we promised to pay by the 11th of March. So we've got an obligation. But what was the past event? That one's a little trickier. What was it? Did we buy something? Not really. So the past event here is usage. During February, Box Hill Furniture used or consumed up phone and internet services. And when you do that, that's a transaction. You're agreeing to pay for that in the future. So that is your past event, the usage or consumption. Lastly, liability will result in an outflow or transfer of future economic benefits. So basically all that means is we've got to settle it in the future. So we've got to settle the debt. What do we settle debts with? Well, it's always going to be cash in our subject. So that's pretty easy. So we just say, let's take our example. We've got our $20,000 of inventory. We promise to pay. That's an obligation. How or what economic benefits will be sacrificed? That's easy. That's cash. We're going to settle all our obligations with cash. So let's just have a look at some common liabilities that we're going to come across. We're going to come across accounts payable or creditors. That's the money owed to other parties from the business because we purchase goods or services on credit. What else? Loans. That's the money owed to a bank for a loan to buy any item other than the business itself and the property on which it sits. So that could be to buy a car, for example, or a computer. That's different to a mortgage. A mortgage is just a different type of loan. It's still a loan. It's just the loan you take out to buy the business itself or maybe the property on which it sits. We'll deal with bills payable. So the amount owed for an expense that hasn't been paid, e.g. the rent, The telephone, we'll put wages separately and say that's probably going to come up on its own a bit. That is where we owe employees for work they have performed but not yet being paid for. And we'll deal with taxation payable. We'll really only deal with GST, but that is when we owe money to the Australian Tax Office, or ATO. Alright, so is this a liability? All we're going to do now is apply our theory to some examples. The business bought inventory from a supplier for $10,000 last month and payment is due next week. We've got our 3 criteria and we just take it one step at a time. And we say, is there an obligation? Yes, the business has to repay the supplier for the inventory. You're legally required to do that. You can't get out of it. That is a present obligation. Was there a past event? Yeah, we bought some inventory last month from the supplier. That's a transaction. A transaction is a past event. Lastly, the business will have to sacrifice $10,000 cash to settle this obligation. So that is an outflow of future economic benefits. Tick. Next one. The business borrowed $20,000 from ANZ Bank and has to repay $2,000 each month. There's our criteria. First one, yep, there is an obligation. What is that obligation? We have to repay ANZ Bank. We're legally required to do this. What was the past event? Well, that was when we went to the bank, filled out all the forms for the loan, and the ANZ Bank gave us money. That's a transaction or a past event. And lastly, the business will have to sacrifice $2,000 cash every month to settle this obligation. That will be or represents an outflow of future economic benefits. Last example, the business owes $7,500 in wages to an employee for work performed last month. 3 criteria. Is there a present obligation? Absolutely. The business has to pay the employee their wages, legally required to do that. Was there a past event? That's a little harder to explain, but there is. We say the past event was when the employee turned up for work every day, performed their job last month. That's a past event. And is there going to be a future outflow of economic benefits? Absolutely. We're going to have to sacrifice $7,500 cash to settle this obligation. So now we have an outflow of future economic benefits.